Bond markets have a reputation for being dull, but right now, on a trading desk in New York, billions of dollars are being used to quietly challenge the Federal Reserve's narrative. The Fed's leadership is currently taking a hawkish stance. To keep inflation under control, policymakers are signaling that interest rates may need to move even higher before the year is out. Bond investors are looking at the same economic data and reaching the opposite conclusion. They're putting massive amounts of capital behind the bet that rates will actually drop over the next 2 years. Economists often prioritize these market moves over official press conferences for one reason: bond traders lose real money if they are wrong. Unlike a political forecast, a bond price is a commitment of capital. Because this capital is at risk, the market acts as a highly sensitive predictive engine. It reveals the consensus of the world's most informed investors, showing where they expect the economy to go, regardless of what institutions say. This chart shows the yield curve. It tracks a wide variety of interest rates, each tied to how long an investor is willing to lend their money to the government, from a few months to 3 decades. The 2-year yield functions as a real-time tracking pole on the Federal Reserve. It reflects where the market expects the central bank to set rates in the immediate future, updated every second the market is open. The 10-year yield is the benchmark for the broader global economy. This rate dictates the cost of a 30-year mortgage, the price of corporate debt, and the formulas used to value the entire stock market. The 30-year yield measures long-term fiscal stability. It prices in decades of future and debt, reflecting how much trust investors have in the government's ability to manage its bills for the next generation. These 3 points represent different groups of people making different bets, but they all connect to form a single continuous picture of the future. In a healthy economy, the curve slopes upward. Lending money for 30 years is riskier than lending it for 2, so investors require a higher interest rate to compensate for that time. Occasionally, the relationship breaks. Short-term yields rise higher than long-term yields, causing the curve to invert. This inversion happens when investors become so concerned about an upcoming slowdown that they expect the Fed will have to cut rates soon. They rush to lock in today's long-term yields before the economy weakens and rates fall even further. Between 2022 and 2024, the United States experienced its longest yield curve inversion in modern history, leading to constant speculation about when a recession might finally arrive. By late 2024, the inversion ended and the curve returned to its normal upward slope. However, history suggests that the moment the curve uninverts is often more dangerous than the inversion itself. Looking back at 1989, 2000, and 2007, the pattern is consistent. The curve inverts, people brace for impact. The curve uninverts, and markets relax. And then, with a lag of 6 months to 2 years, the recession finally hits. This historical lag is why economists treat the uninversion as a warning rather than a sign of relief, monitoring the data even after the initial panic has faded from the headlines. Having crossed that 2-year window since the 2024 uninversion, we have arrived at the current landscape of mid-2026. The primary curve between the 2-year and 10-year yields is positive, placing us in the middle of that historical danger zone. While the main curve looks normal, the 3-month versus 10-year spread has flipped back to negative. This keeps the statistical probability of a recession elevated at over 30%, even as the broader public narrative remains optimistic. This tension is being compounded by a recent oil price shock tied to conflict in the Middle East. Higher energy costs are driving up inflation forecasts, giving the Federal Reserve a reason to stay aggressive with their interest rate talk. Yet the contradiction remains. The 2-year yield shows that despite the Fed's tough language, investors are still betting that rates will have to come down significantly within the next 24 months. At the same time, the 30-year yield is showing signs of long-term stress. The term premium, the extra return investors demand for long-term lending, is creeping up as the market expresses doubt about the government's long-term debt trajectory. The bond market is currently functioning as a multi-layered lie detector. It is simultaneously questioning the Fed's resolve, flagging a hidden recession risk, and gauging the sustainability of the national debt. It shows that while the headlines may be calm, the most informed money in the world is still bracing for trouble.